All right. Good morning. Today is Wednesday, April 20th. Recording is on. Today, we're going to talk more about multiples in your multiples assignment. But before we do, just doing a quick check-in on the Bloomberg Trading Challenge. More than halfway done. So, let's see how we're doing. So this is section 101. All right, we can see everybody's made the minimum 10 longs. That's good. Basically, everybody has less than the 300,000 of available cash, which is good. And these are the rankings. We see 4 teams in the black, 2 teams losing money, 2 teams at the top, very close together. Actually, all 3 teams are fairly close together. Only about $4,000 separates them. But this is kind of quick pick for quick peek at section 101. So we're here. Let's check out section 201. There's 22. There's 201 second half. In this section, all 6 teams are in the black. Everybody's made the minimum 10 trades, and everybody's meeting their minimum cash. Let's look at section 301. 401, so it's right here first. 401, and portfolio value for the teams in the black. One team, this is the best I've seen across all of the sections so far. 5 of the 6 teams have made the minimum 10 trades. Remember, you need at least 3 more to qualify. And check on section 301. All right. Again, this section, we still got some more trades to go. These 3 teams need to get to 10 longs. And again, 3 teams in the black, 3 teams in the red. This team's not doing nearly as well as some of the other teams. But basically, this is where we stand as of today. Remember, keeping equities, don't keep in cash, minimum 10 longs. It's about 4 teams that need to get up there. And just kind of quick view of how we're doing in the trading challenge. Any questions about the trading challenge? All right. So for today, your assignment, which was homework 9, was to perform multiple analysis of these 3 pharmaceutical companies, right? And to explain why they are trading at a premium or discount. So let's go ahead and put up Excel here. Just trying to find the solution. So not that one. Sorry for the delay here. Oh, here it is. Okay. Zoom share. So actually share my desktop so I can go back and forth. Sure, my do not disturb is on. All right. So the first thing we needed to do for 3 companies is put in the data for the price to earnings multiples. And so our 3 companies were Merck, these are ticker symbols, MRK, Pfizer, PFE, Johnson & Johnson, J&J. Clear out this data. All right, so I'm gonna do it and just to make sure in real time so everybody can see this. So back to Merck. We're gonna need 2 screenshots to do this. One we're gonna need is the WACC. So that is gonna get us both the cost of capital for the EV to EBIT multiple and the cost of equity for the PE multiple. Okay. So today, Merck's cost of equity is 6.4%. So go back to my Excel file. Cost of equity is 6.4%. And percent. And over here on the EV to EBIT, let's go ahead and get this out of the way. The WACC for Merck was 5.9. Right. And the other important thing here is take a screenshot. Don't submit screenshots, you're not getting credit. So MRK dash WACC. Yes, overwrite that. All right, now you have 2 choices. We can finish Merck, or since we're going to do all 3 companies, we just kind of stay here at the screen and put in the other data. So I'm going to go ahead and get Pfizer real quick. So Pfizer, cost of equity 6.9, WACC 6.5. So WACC 6.5, Pfizer 6.9. 9. Type. All right, and final one is J&J. Cost of equity 7.3 and 6.0, 6.9. Also 6.9. Oh, no, that's 7.3. 3 and 6.9. Okay, so we have, I have to take screenshots of this advisor. Go ahead and do that. Save. J-WACC. Save my Pfizer screenshot. All right, then we're going to go ahead and do the earnings estimate, EEO. So I'll start with Pfizer since I'm here. A couple pieces of information. So first, take a screenshot before I forget. All right, so again, we're going to use second forward year. So actual count 1, 2. There's my second forward year. And we're using net income in the second forward year, which is the first 12 month of clean forecast. So their net income is expected to be 30.879 billion. So right here, 3879. And on down here, here is the PE based on the second forward in year. So there's the price, there's the EPS in the second forward year, there's the PE. So they're trading at 9.27 times 23 earnings. So here, oh, from the wrong column, 9.27, 30. Okay. All right. And then might as well go ahead and put in the other multiples. So EV to EBIT for Pfizer in the second forward year right here is right there. EV to EBIT. Second forward year is the trading 8.4 times EBIT in enterprise value. All right. And you'll notice in this version of the spreadsheet, we're going to add the third multiple that we're going to have to start to explain, which is EV to sales. Okay, also as enterprise value to sales multiple, or how much value are you creating for every dollar of sales that you generate, as opposed to how much value are you creating for every dollar of EBIT that you generate. Okay, so here our enterprise value to sales, also known as enterprise value to revenue multiple for the second forward year is 3.61. Okay. Now for Pfizer, the other thing I need is my expected return on equity and expected ROIC. So either scroll down or minimize, and you can start to see Pfizer's return on equity for the next 4 years. So 44%, 27%, 19, 17. So the key is for all of these companies, what is it going to be long term, aka perpetuity, right? And one of the things we have to start thinking about is like, why is Pfizer's ROE bumping up so much and then going down? So is that, indicative of the company's future? Well, one of the clues here is their revenue goes from 80 to 107 and then back down to 60. And essentially, if you kind of dig in here into company specific data, what you'll see is they are getting a current bump right now from their COVID vaccine. Okay. Remember, Pfizer and Moderna are kind of like the two leading vaccines in the United States, and again, in many other countries. They're the mRNA vaccines, but long story short, people are expecting COVID to subside or go away or be stable long term. So therefore, the vaccine business is not going to be as strong as it is right now. And so that's the slowing down of the revenue. So they're getting a short-term bump related to COVID vaccines, and then it's kind of coming down. So the reason I'm saying this is that when we think about like what is a more realistic long-term return on equity, and to some degree ROIC, like it's the out years that are probably more representative after the bump from the vaccine goes away. And this is probably more realistic for Pfizer, somewhere between 17 and 19%. So I'm going to split the difference and use 18% as the expected return on equity in the long term. Okay. So then I'm going to come over here, and we need to get an ROIC and a tax rate. Okay. So let's go back to Pfizer. I'm going to check out company guidance just to see if they have a tax rate in their guidance, and they do, 16%. Great. So I'm going to use the company's tax rate guidance, 16%. And then the final question is, what is a reasonable ROIC, which we'll go to RV. Custom. And I don't know why my operating ROIC has consistently been missing. So there. I don't know why it's not there. Formula library. All right. So I'm just going to go ahead and do this as a spread. And more importantly, save this. See, so I don't have to keep searching for it. Yes, I'll write that. All right, so the question, well, my terminal is being very slow today, is these are the operating ROICs for all of the pharmaceutical companies. And in this case, we care more at this point about Pfizer, which is 31%. And the real question is, what is it in perpetuity, right? Now, one way that we could have gotten to this number is if we did the full DCF valuation. Because if we did the full DCF valuation, well, at that point, we get a better sense of the year 6 ROIC. And I think that's probably a good way of thinking about what we think Pfizer's long-term ROIC should be, right? Because again, what we're trying to represent here is what does it look like in perpetuity. And so here we have last year being 31%, okay? But the problem is that we know that last year was a little distorted by the COVID vaccines, right? Because we just saw the big sales bump they had, which is going to go away, which is why the longer term return on equity was much lower than the longer term or the current return on equity. Well, the same is probably going to be true for the ROICs. Like Pfizer's not going to have a 31% ROIC into perpetuity. It's going to go down because they have the current bump from the vaccines. So the question is, how much does it go down as we think about this? Well, we have Pfizer at 31%. And second thing I'll just point out here is the return on equity is closer to 18. Okay. Well, how do we get to 18? Right? Essentially, this is, we can use the concept of sort of a debt to capital ratio, debt to equity ratio, because debt divided by debt plus equity would be the percentage of debt, equity divided by debt plus equity would be percentage of equity, and get a sense of if they have a sort of a capital target, then we can turn an ROE into an ROIC. Okay, and so I'll show you the formula down here that we're about to go through. So let me go to draw. So ROIC, now I'm going to use kind of a simplified version, but is profit divided by debt plus equity. All right. So essentially, if I look at our return on equity, it's profit divided by equity. So essentially, what I need to do is take my debt plus equity divided by equity. Okay. So the key is I can get from the PE to the ROIC. This is PE. See the PE there. This is ROIC. Because they should be related. So the question is, what is the debt to equity ratio, right? And if I divide that PE divided by that, I should get the ROIC. Look, they're saying that. So what is the debt to equity ratio of Pfizer? Well, we actually know that because if we go back to the WACC screen, we have the debt and we have the equity right here. Right? These are market weights, but that's the idea. When you do a WACC, you do it based on market weights. So the capital structure here is based on market weighting. So Pfizer's about 89% equity and about 11% debt. So in this case, debt plus equity divided by equity is debt plus equity, we'll just do it this way, equals 100 divided by, what's the equity ratio? 11 is about 9. Okay, so the ratio is for every dollar of debt, they have $9 of equity. Right? That's basically what that ratio tells me, 9 to 1. Right there. So back to this. So this is 9, right? And we know the PE, then the PE, which right now is 9.27, the actual 9.27 divided by 9.1 equals this, and then take all that. There's 1, and it's going to be around 18%. Decimal places off, but it's going to be somewhere around 19%. Decimal places off. So there's the point. Like this is probably realistically more like 19% than it is 30-something%, right? Because the 19% ROIC, actually it's got to be less than 18. What did I do wrong here? Let's keep it simple. I'm just going to take 90% of 19. Use that. Equals 19.9. 9 times 0.9. It's around 17%. So somewhere around 17%. Is their ROIC. Okay, just given that they're 90% equity and 10% debt. Okay. Questions about how I'm getting to 17%? Actually, it should be 90% of 18 equals 18 times 90%. Sorry, can't do math this morning. That's 0.9. There we go. 16%. Should be somewhere around 16%. Should be their ROIC. As opposed to, we're all trying to get to is, where was here? As opposed to, here was the return on equity, right? So we're saying this is more indicative. So 44% return on equity ties more to bring our receipts back. Bloomberg is being slow, but ties more to the 31% ROIC. But we said it's not going to be a 41% return on equity long term. It's going to be closer to 17 to 18% return on equity. So if you have 17 to 18% return on equity, you can't have a 31% ROIC. So those have to sync up, right, when we do our assumptions. So if you're going to have a 18% return equity, then your ROIC is going to be closer to 16%. Okay. So essentially, that's what we're doing here. We're putting in, because remember, we're dealing with perpetuities, and we need to have a reasonable understanding of what a company is going to look like in perpetuity. And this is what we're putting in as our more reasonable understanding. That's why I have 16 here. Questions on any of this? Okay. Well, then now we're going to go solve for our G's for Pfizer. And essentially, we have crap on the screen. Delete it all. It's annoying and getting in the way here. There we go. All right, so back to this. Got to do the same thing for Merck and J&J. All right, and solve for my G's. So back to Pfizer, the G here, and I will use the solver under the what if analysis. We'll seek. So I'm going to set cell PE to 9.27, changing that cell. So my G for Pfizer is going to be negative 9.7%. So why would it be negative 9.7%? Here. Well, if you think about it, it's not that Pfizer's going away. Remember that we're doing it based on the income today and the long-term future. The reason why it would probably be a big negative G is my drawing tools. This is sort of your cash flow over time. This is Pfizer today, and this is Pfizer in 3 years. Okay, so if you think about it, Pfizer is going to be smaller, right? So in a sense, what the market is saying with this 9.7 G being negative is we think that Pfizer has peaked, and we think that they're not going to keep growing at the same rate. They're going from a $100 billion company to a $70 billion company, and they're going to probably be closer to a $70 billion company long term. So therefore, to get to their negative G. Okay? And again, it was just because they had a short-term bump, and we saw that clearly in their data, right? So it's explainable. Now, if I put a negative 9% G in Walmart, I'd be like, all right, something's going on here, right? But with Pfizer, I can explain that. So back to questions. Let's do our G for our EV to EBIT. Same idea. Draw. So again, I'll use my what if tool. Data, what if, seek. So I'm going to set the cell, where's EV to EBIT model to the 8.4. Solve for it by changing C5. So same idea. I'm getting a negative G here. And as I said, normally a negative G that high for a mature company would cause me some concern. But as I said, I have a better understanding of why it would be negative for Pfizer, given the uniqueness of their short-term win. It's a one-time thing. And so that's the thing. The market's treating this vaccine bump as one time, not long-term recurring, right? And you kind of see that's why the G is coming down from their current value, and they're not getting the big multiple bump you would expect from all those sales and profits today. All right, so that's what's kind of going on with Pfizer, even before we do our discounts and adjustments. Now here, the other thing we're going to do that I've added to this worksheet is I've created the concept of the EV to sales multiple, right? So if you remember, when we went through the multiple lecture note, 6, we said that EV to sales, also known as EV to revenue, was your margin, that would be your EBIT margin, times the enterprise value multiple, EV to EBIT multiple, right? Because that was the key value drivers rearranged that got us there. And that was the EV to EBIT multiple. That's the bottom there. So this equals that times this, right? So we know, because we've already been doing this, that the enterprise value to sales multiple divided by the EV to EBIT is our margin, okay? So EV, enterprise value, is margin times EV to EBIT, right? So here's the point. On the spreadsheet, this is my EV to sales multiple. That's my EV to EBIT multiple. That is my EBIT margin. Okay, so that is the perpetuity EBIT margin for Pfizer, based on those multiples. We've already been doing that in our valuation model. Now, next thing is, this is a tax rate. So this is my NOPAT or NOPLAT margin. Okay, so it's my EBIT margin after tax. Okay, just taking that times 1 minus tax rate. Right. So here's the thing. Also, what the multiples show us is what is the productivity or invested capital to sales multiple. So if you remember in our valuation models or our ROIC trees here, we've been looking at IC to sales, measure productivity, which just happened to be an old one I had sitting here, right, for Costco. So this is invested capital to sales. Well, that's the point. The multiples actually tell you what the invested capital to sales ratio should be for a company, because same idea, my terrible drawing skills here, that profit over sales times sales over investment equals return on investment, profit over investment. So here's the point. This is the sales to investment multiple. These cancel out as equal weight. And what we said is we're doing the reciprocal. We're doing I to S just so we can add things up and we can keep everything as related to per dollar of sales. So we just do reciprocal of this, but this is the idea of productivity. So sitting here in plain sight is the invested capital sales multiple, because we know this times 1 over this has to equal that. That's that formula right there. So if we know this and we know this, we can solve for this. That's all I've done here. Okay, so that's this cell. So I backed into the invested capital to sales multiple because I know the margin and I know the ROIC. So I know what the market expects the productivity to be. So 2 things. One, in just a minute, we're going to start explaining a third multiple, and what the third multiple, EV to sales, is going to also get us insight to is expected productivity of the firms, right? And 2, we can use this expected productivity if we do multiples to help us with our valuation models. Because you remember, we valued Merck, and in the bottom of your Merck forecast, the bottom of our valuation models, we have an IC to sales multiple. So you can actually use the multiples in the real world, not only to get help you get a better sense of what's happening with the G, right, and what's happening with the margin, but you can also use the multiples to help you get a sense of what the balance sheet is going to look like, because it's built in to the multiples. They're all kind of very related. Told you, all this is just rearranged math. Again, questions about any of this? Because in your next assignment, you're going to have to do this. You're going to put in this. Okay. So this is your EBIT margin, okay, which is the EV to sales divided by EBIT. This is the EBIT margin after tax. So it's that EBIT margin times 1 minus the tax rate. And this is, see the formula here, the operating ROIC divided by that margin, and just taking the reciprocal of that. Okay, so that's going to be your productivity. Right? So that gets you this times 1 over this equals that. All right, so let's continue on. Next company. Save the screenshot. Now, because this already has Merck and J&J, if I'm taking screenshots, I only need really one RV screenshot. There's Merck and there's J&J. Okay. All right, so let's go back to, we'll do J&J. Let's do Merck. All right, so for the Merck multiples, go. Right here, we are going to put in their expected net income. So income second forward year, 17,830. We'll also take screenshot here.
Professor, I think you picked up the wrong year for the expected net income.
That's possible. 17,830, second forward year. 17,830. Not check that
All
out.
right, sorry.
Okay. No. It's early in the morning. I'm prone to mistakes. So please feel free to call them out and I won't feel bad. So 17,830, second forward year. Right? Now, again, we're going to have to go here to guidance. See if they have a tax rate guidance and 13.5. Now, this should be easier for you because you've just done a valuation of Merck, so you could have pulled stuff out of your model. So here would be a question. Operating ROIC. So we'll go back to the RV screen. And I'll look at the operating ROIC here, which is the current one. And while I'm doing that, one of your teams that presented on Monday helped me out. What was the operating ROICs? Which is your terminal value ROIC that should be in the assumptions tab that you guys used in your valuation models that you presented. What'd you get? Because many of your teams had the right G's, -2% for Merck. Okay, that's what your model said. So what was the ROIC in that model? Because that would have been the perpetuity ROICs. So can somebody just quickly look up your negative G and your -2% G's? What was the ROIC in your assumptions? Because otherwise we have 25.31 as sort of the Merck ROIC. And I'm just curious how your valuations were compared to that number, which is this is the current. And you did a more enterprise DCF, and we are more concerned about the perpetuities. So your perpetuities should probably be more reasonable. I'm curious how close they are to 25. What'd you come up with?
The RV that we had in ours is 25.01.
Okay. By the way, do you mind? Do you have it up on your screen?
Yes.
Can I get you to share it real quick? Let me turn sharing on. Stop my share. Just so we can see it.
Screen sharing is
I just
not
did.
allowed right now.
Yeah, it should work now.
Okay.
So we share it real quick. Thank you for doing this. So what I just want everybody to visualize, just because again, I think they visualize because they can see it might be easier, is in your assumptions tab of your as is valuation. Okay. Then over on the right, you have cell B6. So we have cell B6, 25.1. Because remember, that's where when we did our valuation, if you go to the EPEOY tab, thank you, on the far right column M, that was the ROIC, which was M16 in perpetuity. Okay, so we had put in some ratios, we put in some things to adjust 4 years of actual more realistic numbers to get to a year 5 and a year 6. And we said that was probably more realistic of perpetuity. And then we did an ROIC. Okay. So I'm just saying, like, if I were doing this, I'd rather get this in the multiples template, because I think this is probably a pretty good approximation of the ROIC, because you just did an as-is valuation matching their current share price. So kind of this is how the math is going to work, right, with some reasonable assumptions. So we're just triangulating here. So thank you for sharing that. So what I was trying to say is, okay, if I'm being lazy and I'm just trying to do put up my finger and see how the wind's blowing to check the weather. Well, when I do this, let me share my desktop. When I just kind of put up my finger and say, what do I think the ROIC is? Well, this is my starting point. So Merck's around 25% today, right? Now the question is that representative of the future? Well, Merck is a little different than Pfizer, right? Pfizer's got this giant bump that's going away. Merck's got this Keytruda drug that you just told me on Monday that's going to be, very, very important to their future, and it's sticking around for a while. So they got some patented drugs that, they're going to start going off patent, some of you said, in 27, 28, but it's not like Merck is going to see sales fall off a cliff like Pfizer. We saw that in their EEO. So a little different story. So today, the past is kind of somewhat representative of the future. And so we could have actually used this 25.31 and been reasonable, and our valuation models helped us triangulate that. So unlike Pfizer, I don't have to make an adjustment to Merck's ROIC and the multiples. Because remember, multiples are all about perpetuities. So if I go back here, I'll actually use 25.3. Does everybody see that? The logic, why we're doing that? Why would we make an adjustment here? Why would we make an adjustment with Pfizer? Any questions about this? All right, so back to EEO for Merck. Screenshot here, I'll take one anyways. Hurt to have multiple screenshots. Yes, I did. All right. So second forward year for Merck, 11.99 PE. And what's this EV to revenue is 4.38. And EV to EBIT is 11.45. All right, and finally, expected return on equity for Merck. Scroll down or minimize, your choice. I think it is probably going to be in the mid-30s, so 35, 35, 37, so somewhere around at least 35. Okay, so I think that is representative for Merck. And so I'll go back to my what if we'll seek and solve for the G. So I'll set that to the 11.99. Changing that, and that's about 2.5%. Now that number shouldn't surprise anybody on this video, because you just did the Merck valuations and you all came up on Monday in your as is with a negative G. And most of you, when you did your target valuations, still had negative Gs. So the fact that the market is valuing Merck with a negative G with the multiples should not be a shock, right? So essentially for the reasons that you guys talked about in your presentations, right? So again, we have the negative G for Merck here in net income, and we're probably going to get a negative G here because this is the one that would be closest to what you did your valuation models. So how do you get from a 14.6 with a 0G to an 11? We have to have a negative G. So 11.45. Changing that. And we're going to get, again, the 2.36. This is almost identical to every presentation that I heard on Monday, right? Because again, Merck stock price is about the same this week as it was last week. And when you guys did your valuations, your as is, you guys came out with a DCF. As I said, this is just another way of saying that multiples are rearranged math. I mean, that was the whole point of why I started here with the key value drivers, which is free cash flow in perpetuity. And then we just rearrange it to get the various multiples. And that's the point. Like, it's, these things have to sync up. That's actually why we can start to triangulate in the real world. And what I like to say is multiples are just the shortcut for the enterprise DCF. Or it's easy. I just got to do 4 numbers and I got a valuation, right? Enterprise DCF, I got to do a whole model. That's one of the reasons why Wall Street likes multiples. They're simple, right? You know, DCF hard, multiples easy. They like easy. They paid a lot of money for easy. But the other part is that they're based on real world numbers. Okay, so it makes it more valid as opposed to the theoretical value, which is in a spreadsheet. So some reasons why people prefer multiples, but they have to kind of sync up. Now, final one you had to do is J&J. So just really quick, go a little faster on this one. So J&J. All right, their return on equity, just out of order, was pretty stable. 34, 32, 30, 27. So it's like 28. And 28%. And their PE, well, I minimize the bottom screen goes away, so I just reload it. All right, so PE in the second forward year would have been 16.72. And on the screen, second forward year net income 28,705. Right. And over here, EV to sales, they're trading at 4.81 times second year forward sales, and they're trading at 14.62 times second year forward EBIT. Okay. And last but not least, save this. All right. Then we go to the tax rate. GID, 16%. And the real question is, what is their ROIC? Now, here's the deal. When I looked at Merck, today and tomorrow look pretty similar, right? And I saw that because the ROEs were pretty consistent over time. Now they changed a little bit, and that is because the company is buying back stock, right? We all saw that in our CFI of Merck's when we did this. So that's why ROE kind of shift a little bit, because the debt to equity ratio is actually changing slightly as they're buying back stock, right? And that manipulates earnings, rises EPS, right? But, and therefore can impact ROE. But the whole point is it's been fairly stable. And Johnson & Johnson's ROE is fairly stable. And with Merck, we saw with a fairly stable ROE and that fairly stable capital structure, ROIC today is similar to ROIC tomorrow. I think with J&J, we could probably make a similar assumption. So somewhere around 49% is probably a reasonable number for J&J, right? Now, we did see 49% here, PEO. We did see it go down from 34 to 27. Okay, so that's about a, I don't know, call that a 20% drop in ROE over the 4 years to get to 27, 28. It's 28 divided by 34. So equals 28%. And that's what I'm using, divided by 34. which is where they are today. It's about 82%. So in a very simplified way, I could basically say this operating ROIC will be 82% of the, was it 43? I think it was. Better memory than I do. Was the operating ROIC. So given the ROE, and again, just oversimplifying what we did earlier, 49%. So 49.27 49.3 times 0.82 at 82%. I'm going to say it's closer to 40. It's still very high into perpetuity. We see how I made those assumptions, how I got to the 40. Questions about that? Throwing a lot of numbers at you.
How did you get the 82% again?
What I just did is I just said, take the ROE that I'm using here, the 28%, and take the 49% that I saw on the RV screen. Oh, sorry, 0.28, 0.34 again.
Was that the equity percentage?
What did I just do? Sorry, 0.28, 0.34. How did I get 0.34 again? On my
Was that from the wax screen?
trying to remember where I got the 0.34 from. Oh, no, sorry. I know what I did. Sorry, brain freeze. EEO. So what I did is I said, they're going to get down this. I'm calling this 28. Today, they're at 34. Okay. So we basically say that in the future perpetuity, I'm using 82% of today. Okay. So I'm just giving you another way to swag this. So if I'm using 82% at a constant capital structure, then essentially here, 82% of today's return on equity, then I'm going to use 82% of today's ROIC as a swag, assuming constant capital structure. It's kind of a simple way of simplifying what we did earlier. So that's where I went to Excel. That's where I took 82% of the 49% to get to about 40. Okay. So if their ROIC today is around 49, I think it's going to be closer to 40 in perpetuity because I'm using a 28% perpetuity ROE versus a 34% perpetuity ROE. Does that make sense?
Yes, thank you.
Yeah. Now, thank you for making me clarify that so it's clear to everybody, clear as mud. So back here in the data, let's go back to our what if. So if I solve for my G, so set that to 14.62. Changing this. We see that this is going to be different than Merck and Pfizer, where J&J is not expected to shrink. And here on their ROE, same thing. So even before I do my 16.72, even before I do my multiple analysis in detail, just at a high level, what's going on with these companies? Well, you have some insight from your presentation. We know Pfizer has a negative G and is not expected to grow because they've kind of peaked with their vaccine for COVID-19 that's given them a big $30 billion bump of sales that the market thinks is one time and is not recurring. We know Merck is expected a long-term G because King Keytruda is eventually going to go off patent with another couple of drugs. And this is kind of like peak Merck. So Merck is about as good as it gets with their margins and their profits, their cash flows for the next few years. And it's probably not going to be as good in the future because Keytruda, which is 1/3 of their sales, is going to go off patent and it's going to be hard to replace that big a drug. So Merck is going to be flat to slightly declining over time because they're going to be a little bit less off long-term, a little less well off long-term than they are today. Again, that's what all of your teams essentially explained to me on Monday. J&J, different story. J&J is expect steady state continuing to grow. Now, J&J also has consumer products businesses outside of pharmaceuticals. So they don't have as many patent expirations. You know, you're already buying Band-Aids from J&J at pretty high prices. So they're really about their brand and their brand power as much as their patents, right? So they have a little bit of a different type of portfolio than some of those other pharmaceutical companies because J&J has a lot more consumer products than Merck and Pfizer. They also have a few other businesses that are outside of pharmaceutical. So because of that, they are not seeing the fluctuations of losing their big patent drugs, and the market is expecting them to grow over time. And you're already seeing that in the data here before we even start to do why companies are trading at premiums or discounts. So now we go into premium or discount. So again, back to language. When a multiple is lower than somebody else's, it's called a discount. When a multiple is higher than somebody else's, it's called a premium. So for purposes of your assignment and your papers, you should have said that J&J is trading at a premium to Merck. Pfizer is trading at a discount to Merck, okay? And you should also know that at this point, the reason why you trade at a premium or discount is because multiples are an expression of growth and spread. And so we have the growth of the spreads here, and these are the equity ones. And so the question is, why is Pfizer trading at a discount? Okay, and we can see two things. One, they have a lower spread than Merck. Pfizer's spread is about 18 minus 7 is about 11 points, 11.1%. And Merck spread is close to 29 points. So Merck is a higher spread. And Pfizer is also expected to shrink with a much lower G at negative 9.7 than Merck at negative 2.55. And so that's two of the reasons why Pfizer is trading at a discount of 9.27. But there's a third reason. Their cost of capital is higher. Because their capital cost was 6.4%. Now, it'd be not as high as 11.99, but they are losing another, call it 20 basis points, 30 basis points, because of the cost of equity being slightly higher at Pfizer. So three things are going on. So Pfizer's trading at a discount because they're expected to have lower growth, reasons we've been talking about, because they have lower spread, so the lower growth spread combination, right? 11 versus 29, and slightly higher cost of capital, equity cost of capital at 6.9 versus 6.4. That's why Pfizer's trading at a discount. Why is J&J trading at a premium? Well, it's pretty clear. So even though they have a slightly higher cost of equity, which is going to mute that PE, because if they had Merck's cost of equity, 6.4, their PE would be close to 20, right? But they don't have Merck cost of equity at 7.3. There's a little more risk in J&J perceived by the market, so volatility. So therefore, with a slightly higher cost of equity, it's the lower spread than Merck. 28 minus 7 is only 21 points, or J&J and Merck, but they're expected to grow at 1.7% per year. So they're growing their positive spread. Merck is shrinking their very positive spread. And that's why J&J is trading at a premium to Merck of 16.7 times earnings. So if you're advising Merck and you're telling them, how do you get a better stock price? I'll show you something interesting. If I drove my ROE to 60%, it's going to barely make a dent. Because once you start getting extreme high rates of returns, what it really means is you have very little capital in your firm. So you're already just generating a lot of free cash flow. And incrementally, it doesn't add that much more free cash flow once you get to very high levels of ROIC. What's really going to make a difference for Merck? Find new drugs, right? That's going to make the difference of how Merck is going to catch up with J&J stock price. They need growth. They don't need more margin. Okay. And that's the other insight that we start to get once you get to extreme margins. When you get to extreme margins, it's all about the growth. When you have very low margins, then growth doesn't matter as much and the margin has to impact. That's the other thing you start to see as you play around with these multiples. Now, what's going on over here with the EV to EBIT multiples, it's probably a similar story. Okay. So for EV to EBIT, why is Pfizer trading at a discount 8.4 to Merck of 11.45? Well, Pfizer's got a higher cost of capital, 6.5 versus 5.9. That's one of the reasons why they're going to trade at a discount. Second, Pfizer's got a slightly higher tax rate. Not going to make a huge difference in this example, but it does explain another reason why they're trading at a discount, 16 versus 13.5. Their growth is -9 versus -2. That's probably the biggest reason. Pfizer is expected to shrink far more than Merck, even though they have a lower spread than Merck. They are shrinking at a faster rate because Pfizer's spread is about 10 points. Merck's spread here is about 19 points. And so, but the -9% G with a 10% spread is worse than -2% with 19-point spread. And that's why Pfizer's trading at a discount. Why is J&J trading at a premium? Well, even though they have a higher cost of capital, 6.9 versus 5.9 for Merck, right, and a higher tax rate of 16 versus 13.5, they have a better operating spread of almost 35 points, 35, 36 points, and they're growing it at 1.3% per year, where Merck is shrinking their smaller spread. So that's why J&J is kind of like the class of the industry when it comes to multiples. That's why people pay a premium for them, right? And as I said, if Merck wants to start trading closer to J&J, they're going to need growth, right? Because here's the point. If I flip this to a positive 2%, then the multiple would surpass, right? Because even though the spread is lower, they have a lower cost of capital. That's where the cost of capital really starts to play. But they don't have that growth. And that's why they're trading at a discount. So for all of you that were saying, you know, your buy, sell, holds, this kind of reinforces the problem with Merck's hold. It's hard to get into the buy range with the stock price because in order to get to the buy range, Merck needs a lot of growth. And in a way, that's the other thing when you're doing your bulls and your bears last week or earlier this week on Monday in your presentations, it started to come out because many of you, when you got your targets, were like, well, we don't see Merck stock price changing all that much versus where we see them today. And the reason is because they don't really have a lot of sales upside. They probably have more sales downside right now, right? Because they don't have any blockbusters. Because that's the other thing about the pharmaceutical industry. Like drugs don't just pop out of nowhere. They have to go through clinical trials. And the analysts are closely watching these clinical trials, which have to be public. And they're going to have to be publicly shown to the medical community to get approved by the FDA. So it's harder for a pharmaceutical firm to have a blockbuster that people aren't aware of. And so Merck doesn't really have any future blockbusters that the market is seeing that are replacing their current blockbusters. And so they're not expected to grow. So that's the point. That's why many of you were probably in the hold range on Monday. All right, final one, EV to sales. This is new, and this is going to be part of your next version when you do this assignment all over again. Okay. So what is EV to sales, right? So again, EV to sales, we just talked about, is a function of one, margin. We get margin on the EV to sales to EBIT multiple. And two, we get a sense of what's going on with the productivity. Okay. So here's the point. For a dollar of sales, right, Merck generates $4.38 cents of value. For a dollar of sales, Pfizer generates $3.61 of value. So for every dollar of sales, it's worth more, right? Why? Well, here's the thing. A lot of things are very similar, but two other insights that we get. Why are sales more valuable? Well, one of the reasons why sales are more valuable is because how much profit do you make when you sell something? Well, Merck is actually making 38 cents every time they sell a product. And Pfizer's making 43 cents every time they sell a dollar of product. So EV to sales ratios are very susceptible to margin. They're very influenced by margin. Okay, margin's key to the formula. Okay, but Merck has a lower margin, yet people pay more for Merck sales. Why would that be? Well, the after-tax margin is 33 versus 36. So again, I should be paying more for Pfizer sales, which make a 36% margin. But here's the problem. Pfizer has to spend $2.23 to generate $1 of sales. Merck only has to spend $1.31 to generate $1 of sales. So another way of saying this, the reinvestment rate at Merck is lower. Pfizer is putting a lot more money to generate that margin. So the reason why people are paying less for these sales at Pfizer is two things. One, the cost of capital is higher. I'm going to discount the cash flows because the cost of capital does matter, all of these ratios. All right, 6.5 versus 5.9. But the real reason why they're trading at a discount of EV to sales is right here, because Pfizer's spending almost twice as much as Merck to generate that 43 cents in profit. So the return on investment is going to be lower, 16 versus 25. Okay, so really what's going to drive the EV to sales ratio is margin and ROIC, because what's going to drive the ROIC is the productivity. So margin and productivity drive EV to sales. Okay. Now for J&J, why is J&J trading at a premium to Merck? J&J doesn't make as much money as Merck. J&J has a higher hurdle rate than Merck, 6.9 versus 5.9. That's not going to help the EV to sales because I'm going to have to discount those cash flows. But why am I paying more for J&J's low margin, 4.8 versus 4.38? J&J only has to invest 68 cents per dollar to generate $1 of sales. Because remember, I started with J&J by saying J&J has a lot of non-patented drugs. It takes a ton of money to go create a patented drug. $1.3 billion for 10 years per drug is what the pharmaceutical industry is spending. So J&J doesn't spend all that. They spend some, but not as much. They like consumer products. So their productivity is better. They're only spending 68 cents per dollar. So even though they have a 33% margin, because they reinvest half of what Merck does, their sales are actually more valuable. And that's why they have a 40% ROIC. They are the more productive company, more efficient. That's what we'd see in the ROIC trade analysis. All right. So that would be the third ratio that you will have to start to explain on your next assignment. Questions? Yes, Peter.
I'm kind of confused why Johnson and Johnson has such a high WACC when they have this stable revenue stream from Band-Aids and things like that. And they just seem, and they have growth. The other ones are shrinking. I just don't understand why their WACC is as high as it is relative to the other two companies.
Yeah, I mean the short answer is we know that they're having a higher beta. So Bloomberg uses 2 years of data when they estimate the beta. So in the last couple of years, Johnson & Johnson's been more volatile. So that's, I mean, for better or for worse, we'd have to probably do an EIC of J&J, and maybe we should make that one of our extra credit assignments coming up to do that, to give more insight as to what might be causing more of the J&J volatility, right? But at this point, we're just kind of assuming that volatility is making the market think that there's a little bit more risk here. We'd have to try and figure out why. But you're right, it is a little bit of a question why J&J would be perceived to be more risky by the market, but that's the way they're trading today. And so there's probably some conversations that without the EIC, we just don't know enough about. So that might be something interesting. As I said, we might do an assignment on this because I am going to give you some extra credit assignments coming up to make up for some points. We already had one, I'll give you another one, and maybe that'll be the one that we could do. So it's a really good question. I don't have an answer other than that's what the market is kind of telling us right now. Other questions or thoughts?
Could you show the estimated NOPAT margin formula one more time?
Yeah, all I'm doing here is I'm just taking the operating margin times 1 minus the tax rate.
Thank you.
So it's like a pre-tax margin, because to get to an ROIC, which is after tax, you have to take this after tax margin times that productivity, right? Now, since the tax rates were pretty similar, I was focusing on the operating margins when I did my analysis, but technically you should be doing it on the after-tax margins. Other questions? All right, so for Monday, we're going to do another multiple assignment on 3 different companies. And in this case, we'll go back to, I want to do, just check one thing before I give it to you. Okay. Okay. And let's see. All right, so those are going to be the 3 companies. Lockheed Martin, Raytheon, Northrop Grumman. We're going to repeat the multiple analysis. It'll be due Monday. You'll need to submit your screenshots. You'll need to write a 500-word paper minimum explaining why Lockheed Martin is trading at a premium or discount to those 3 companies, Raytheon and Northrop Grumman. Okay, on now the 3 multiples, which will be PE, EV to EBIT, and the final one we just added, EV to sales. Okay, so that is your next graded assignment. Questions about that? All right, have a good week. See everybody on Monday.
Thank you.
Yep.
Thank you.